Today on the Tearsheet Podcast.
What's unique about our approach is not only the cool math that we bring to bear to create a more inclusive model, but we don't create this false choice for executives where you just have to give up economics to be more fair. We actually have this approach where it's called adversarial debiasing, where we're able to use machine learning to do trade-offs between accuracy and fairness and come down on that absolute efficient frontier where you can literally have your cake and eat it too. You can have good economic returns as well as be much more inclusive at the same time. And one of the largest mortgage providers in the US, I think roughly a third of the mortgages run through their platform. They're leveraging our technology for that very reason.
Welcome to the Tearsheet Podcast. I'm Zack Miller. When the pandemic hit, lending models didn't catch up quickly enough. Machine learning, like the kind Zest AI has developed, moved quicker, helping lenders to figure out how quickly things were deteriorating and where. ML models have also been instrumental in identifying and avoiding biases in lending practices. Zest AI CEO Mike Vere joins us on the podcast to discuss his firm's go-to-market strategy and business model and how the two kind of fit nicely. Mike shares his views on how to bring technology to lending and specifically debiasing models to approve more minority borrowers. Mike Vere is my guest today on the Tearsheet Podcast. What could you do with better real-time consumer data? All data aggregation from Fiserv enables access to consumer permission data from over 18,000 sources. Lenders, advisors, fintech firms, and financial institutions can turn this data into actionable insight for their customers. Go to fiserv.com/alldata to learn more. Before we hop into our show, I wanted to tell you about Tearsheet's upcoming Challengers Conference, a first-of-its-kind event. This 2-day online conference is everything about digital banking. We'll have senior executives from top challenger banks like N26, Revolut, OakNorth, and Betterment, as well as new entrants to the digital banking market like Intuit and Credit Sesame. It's all happening September 22nd and 24th. Go to tearsheet.co and click on conferences at the top to learn more and register.
My name is Mike Vere. I'm the CEO of Zest AI. Zest AI is a company that focuses specifically on solving a problem with credit underwriting. We support companies in highly regulated industries to build powerful machine learning models that are compliant. And I think the most important part, Zach, is that we help them do it quickly and easily. That's a process that normally takes nearly a year and a half, and we really support companies and banks through that process.
So I'm curious, Mike, the genesis story. Like, are you a maths person? How did you get here? Where did the idea for Zest sort of germinate?
Well, if I think about my past, I think I've had a consistent track record of building businesses where we're harvesting insight from data. And so whether it's being at JD Power way back in the startup days, all the way to Nielsen, and leading their insight business in North America and Europe. And so it was a pretty natural fit as far as, my background and experience.
And in terms of data chops, as you moved into this industry, did you have them internally? Did you need to go outside? Like, how easy was it to port your experience, I guess, into the financial services industry?
Well, so I had background working with financial services companies in a similar concept, again, looking at data and translating insights. But I would tell you, I've learned so much since I've been here. Actually, this month is 2 years. So happy anniversary to me. I'm waiting on my call. I've learned a ton. The type of math that we're using and that I've had to get up to speed on was actually created after both you and I were out of school. So it really has been a really awesome opportunity for me to sit down with the team and get up that learning curve.
So can you talk a little bit about your go-to-market strategy and your business model?
Okay, so from a go-to-market strategy, I mean, this is an enterprise software sell. So there's many stakeholders that we're going after within a financial institution. It's a team sell. So though we do have client development professionals, it takes everyone from our CTO, Jay Budsick, to myself, to the head of our client engagement practice or client practice, Dan Chiazza. And so it's really a team effort to go within a financial institution and to get them to make that transition. Because Zach, you have to think, we're asking them to take what has been in place for many of them. I mean, they're using maths from the 1950s, logistic regression. And we're first having to convince them that, hey, machine learning is better math and will be better at predicting risk. So that's the first hurdle. And then the second hurdle is now choose Zest AI for that. And so it really takes a team. And what we're finding is, the sales cycle itself really comes together when you have both legal, compliance, IT, credit risk, as well as a business leader, all involved in the decision process.
So as you've sort of tweaked it for your 2-year anniversary, how has the go-to-market strategy evolved, I guess, from your learnings of what's working, what's not working?
Well, I would say in the beginning, when I started, our approach was we'd approach the clients and say, let us do a proof of concept. So that was one sales cycle. And then after we were done with that, you'd demonstrate economic return, and then you'd sell them again and actually license the software to them, which was heavily elongated. I think some of our initial closes were 18 months, 24 months, things of that nature. What we have found as we've gotten traction, and so with over 20 plus customers right now, we're able to actually skip that POC and go direct to license with many of these customers, because ML is continuing to mature within the industry. More and more customers are accepting it as the better approach to underwriting risk. And so now it's really about getting them up and running and demonstrating that economic return early on.
Got it. One of the themes we've also explored on this podcast, Mike, is sort of inherent biases in ML and AI. And we know, there's systemic biases in lending, particularly to minority industry. So how do you guys, are you guys able to shine light on that? Like, do you have clients using Zest to sort of suss that out? Like, can you talk about sort of debiasing, I guess, AI?
Yeah. So I would say, Zach, this is probably the area that I personally am most excited about. We have unique IP around debiasing machine learning models. And it's something where clients have actually come to us, especially today, it's all that more relevant. But what's unique about our approach is not only the cool math that we bring to bear to create a more inclusive model, but we don't create this false choice for executives where you just have to give up economics to be more fair. We actually have this approach where it's called adversarial debiasing, where we're able to use machine learning to do trade-offs between accuracy and fairness and come down on that absolute efficient frontier where you can literally have your cake and eat it too. You can have good economic returns as well as be much more inclusive at the same time. And one of the largest mortgage providers in the US, I think roughly a third of the mortgages run through their platform. They're leveraging our technology for that very reason.
And what are the typical, what are your client sizes? Are you working with large underwriters? Like, what does the typical client look like?
So if you would have asked me 2 years ago, I would have said it's going to be your top 25 because their maturity level and ML IQ was higher. But what we have found, especially recently, is it's the entire range of players. We have a credit union in Houston, Texas, significantly smaller on one end, and then we have the top 3 global bank on the planet actually using our software. So it's a wide range. It's becoming much more accessible to the broader market. And that really, if you think of our software, which is a model management system, that's the point of it, is to make it more accessible to the broad market, not just for the top of the market, the Wells Fargo, Bank of America, Citibank, Capital One, et cetera, but actually all the way down market to that little credit union in Houston, Texas.
And now a word from our sponsor. At Tearsheet's Day-to-Day conference, Fiserv's Paul Diegelman drilled down into the future of personal financial management. Paul, you're talking about PFM 2.0.
It's actually 2 separate and distinct applications. Liquidity is a huge problem right now. People just don't have time to do things twice. Basically, most parts of the country shut down for COVID. Our PFM user growth was over 20% in the first 2 weeks alone. Underrated, 100%. How could we use AI to impact PFM? I'm up for anything that helps people. And to help people, you need an economic model.
To access the full video from Paul's talk, go to tearsheet.co/speedoflife. So what have you learned through those 2 years of how to partner well with big FIs, and how does that relate to partnering with smaller, financial institutions as well?
Well, I think there's two different approaches, and this goes, we try to meet our customers where they're at. And so smaller customers tend to need our help. And so we will go in and fish for them. Larger customers like to fish themselves. And so our engagement with them tends to be teaching them about our software, sharing best practices that we've learned across our clients. And so it's different engagement at different levels. And, we found that necessary given where the market is in its adoption. Our belief is that over time, though, machine learning IQ will continue to increase across the market. More and more customers will be able to access the model management system and actually start automatically building ML models themselves, generating all the compliance and regulatory documents, ensure that it's inclusive and fair, and then deploy it and monitor it. And that's the journey that we're on the next 2 years.
So do you have different team members, different talent working on smaller accounts and bigger accounts based on what they need from you guys?
Correct. Yes. So if you imagine on a larger account that wants to engage with us and leverage our tools directly, so they want to do the fishing themselves. Oftentimes the team on that is much more highly technical because they're going to be pairing off against a team of 200 data scientists at a customer. The flip side is our client engagement team in the mid-market with smaller customers will tend to be an ex-Bain consultant or a McKinsey consultant who not only have the quantitative chops, but are much more used to dealing with the customer and kind of carrying them through a longer process.
So we've talked about big institutions, small institutions. What about credit unions? Like how do you service those guys?
Well, credit, it's I would say it's similar servicing depending on their size. So we work with the largest credit union in the U.S. all the way to some of the smallest. And if I think of, for example, ViStar out of Jacksonville, Florida, Jenny Betterment is their chief lending officer. And engaging with them is very similar to engaging with a mid-market bank. The difference is her objective. And so while she wants to ensure that she's better force ranking risk, what's also critical to her is the member experience. And so that actually pops up right alongside is that member experience, so that many of them have very manual process that take 20 minutes to days to actually get a credit decision. And we're actually coming in and not only delivering better force rank risk, but at the same time, we're delivering that automation for many customers. And I think I've been really surprised this last quarter. The credit unions in particular have been a boom for us. They've really shown, in many ways, they're leading the financial institution, the financial market.
That was going to be my next question. Do you see a sort of a resurgence among them, and based on their values and how they're servicing their constituency?
Well, if our sales and our bookings are any indicator, yes. Many of them are reaching out and using this time during the pandemic to dig in and actually develop a better overall member experience. And you're seeing this resilience, you're seeing this creativity, you're seeing this willingness to take risks. I think of Jason Osterhag at Alliant, which is, I think, a top 10 credit union. That's specifically what he's doing. He's focusing on the member experience, but at the same time trying to deliver economic returns. And we're finding that they're able to change even faster and drive change throughout the organization even faster than some of the larger banks.
Interesting. And so they're also leaning on you for automation help.
That's for sure. That's for sure.
Interesting.
Yeah. Well, you think about their process might have been they'd sit down with a member and collect 20 or 25 points of data, and then they would put it through, look at a scorecard. It would go through 3 or 4 sets of hands before a decision would come back. With our approach, we're able to build Jason at Alliant or Jenny at ViStar, a model that has hundreds, if not thousands, of data points that within less than a second is able to render a decision back, a far more accurate decision back for that member and for that credit union.
Interesting. And you mentioned scoring. So I have to imagine also that credit scoring during the pandemic, I mean, we have Seems to me an unprecedented amount of how quickly things degraded and people lost their jobs and their sources of income. How have credit scores held up, I guess, during this time period?
Well, I hear a lot from banks and credit unions, and I think there's a fairly consistent theme around, they're finding credit scores to be more unreliable. And frankly, to be honest, I think they're also finding them to be less inclusive on race. And so, when there's trying times, there's this disproportionate impact that affects people of color. And so they're just frankly finding them less reliable. Again, if you have an instrument that's set up with only 20 signals, imagine our customers like Discover that would have a model in place with hundreds, if not thousands of signals. It's better able to weather a pandemic, and it's set up in such a way that we can quickly do refits to adjust and learn from what's going on in the market versus the old way of doing it. Banks and institutions that are stuck in the old way of doing it, when they see something like the pandemic, they're rushing around, and it's going to take them 12 to 18 months to get a new model into production using the old logistic regression approach.
So what you're saying is not just the pandemic's effect on credit scoring. It sounds like machine learning is having its own impact on credit scoring.
For sure. Well, I think it's doing a better job of predicting risk, and yet at the same time, if done right, can be more inclusive.
Do you see the bureaus opening up to more alternative data and multiple points in their own scores? Do you see them sort of following you at a certain point?
Well, what I'm finding is that at times there's this great co-opetition with bureaus that we have. On one hand, they love Zest AI because when we go into a customer, machine learning models consume a lot of data. And guess what they're in the business on? To sell data. So it's right. Fantastic. But many of them have these analytics shops that are starting to dabble in machine learning and starting to dabble in analytics and scoring and developing custom scores for clients. And so there's a couple deals in our pipeline right now where we're directly competing with the bureaus, and it's a champion challenger approach. Yeah.
Very interesting. How, I guess this lead, how have we had one of your executives, present at our resilience conference, at our day-to-day conference. And it sounded like, your models were holding up a lot better than anything else out there. And they're certainly a lot more reactive. So can you share with us, I guess, how the models have performed during this pandemic?
Well, I'll share the secret. How about that? The secret is that we use AI to monitor our AI. We actually have an application.
The machines have won.
Yeah, exactly. The machines. This is cybernet for sure. Exactly. And so, the machine, it actually is required. So if you think of most monitoring solutions, they might catch a population shift, meaning we have more people that are coming in and they have bankruptcies. And so they might catch that and say, we might need to adjust our credit policies. With machine learning, we can not only look at population shifts, but we can actually look at the variables and how the variables are interacting with each other, and if there's a variable shift. And so a human trying to sit back and look at a neural network and look at 1,000 variables that have an infinite number of interactions and understand a shift in the population, it's just not doable. Mm-hmm. And so that's where really, when we talk about safely deploying machine learning, that's a part that oftentimes many of the AI shops out there are forgetting. It's not only about building a machine learning model, you have to get it through compliance. You have to ensure you deliver a business impact. You have to make sure that it's inclusive, but then you have to safely deploy it, because who cares if it's sitting in the shop? A number of times, Zach, that I'll sit down with some of the biggest banks that have the most advanced data scientists, and they've got their machine learning model built, but just still up on the shelf because they can't figure out how to deploy it and get it into production.
Wow. So, what a crazy year 2020 has been. And, I'm sure coronavirus didn't figure into your go-to-market plans at the beginning of the year. What are your biggest priorities looking down Q4, thinking about 2021 in the back of your mind? Like what are your biggest goals, both from product side, I guess, and from the business side?
Well, I think there's two goals kind of folded together. So first off is to continue to build out our model management system. what we believe is that will make it more accessible to the broader market, where clients will be able to come in, automatically build a machine learning model, automatically generate all the necessary documentation to bring it into production, ensure that it's fair and inclusive, and then deploy it and monitor it. And so we're going to continue to push hard and own that. So that MMS space is a space that we are creating and leading the way on. There's no one else that occupies that end-to-end part of the continuum. Within that product roadmap, I mentioned fairness, though. From a fairness perspective, that is something that Zest, we are going to be significantly investing in to become the standard in that space. We know mathematically that our approach is the best approach to debiasing a model, and whether it be a logistic regression model or it be a machine learning model. And so we are going to continue to push that commercially within the market, but also amongst the regulators and the government officials to really put our solution out there as the gold standard within fairness. I mean, you probably hear it right now. I couldn't be more excited, because if you think of our mission, this is us living our mission. Our mission is to make a credit fair and transparent to everyone, right? That sounds like apple pie. It's great words. Everybody has these cool missions. We're actually doing it. We're actually doing it as an organization, and we're taking action. And so I'm excited about what we're doing there. I'm excited that, we've come up with a new way to actually assess race. Currently within the market, all the lenders out there have to do an assessment, and they'll be leveraging an approach called BISG, B-I-S-G. And you'll look at an individual last name and their zip code, and you'll be able to assign their race off of that. And what we have found in our study in Florida is that that's not quite as accurate as we would like it to be. And by leveraging better math, we're better able to predict race. And why does that matter? Because this is the yardstick with which all of these institutions evaluate themselves to ensure that they're being inclusive in the marketplace. And if they have a crooked yardstick, what's the point? And so if I think of our two areas in fairness that we're pushing, is not only one is the fix it button, but two, it's actually to ensure that the regulators have an even better tool to assess how a financial institution is performing.
Amazing. Mike, thank you so much for joining us on Tearsheet Podcast today.
Thanks, Zach.